Let's talk about something that every uranium investor really needs to follow closely, and that's the long-term contracting cycle. A lot of us and a lot of people are following very closely the spot market, but in fact, the long-term contracting market is really where the buying is happening. So here are the 4 signs that tell us that we're in front of a major shift. First of all, what we are seeing is the volumes quietly rising. Subsequent to issues at Fukushima, we saw contracting go into the doldrums, and the price of uranium dropped substantially, and a lot of the buying just moved into the spot market, and contracting was really left alone for quite a while. In 2023, we saw over 160 million pounds of uranium contracted, which was well above the average or anything we had seen in many years. 2024, that number slipped off again, but it was still certainly well above the average. This year, we're seeing volumes that are certainly, once again, taking us well above the average. But I think we need to be clear here. What we're not seeing are volumes that have triggered the panic that we certainly expect to see in the near future. As a matter of fact, what we're seeing is that most of the required uranium post-2027 has not yet been contracted. So what this means for investors is that although volumes are increasing, there's still a lot of room for contracting, and we expect to see things moving fast. The second issue we're watching is lead times on all of this. We've seen that utilities have literally been lulled into a sense of false security based on their assumptions around new mines coming online and their availability of working off inventories. What is certainly being realized, though, in recent years is that bringing these new mines online or even restarting old mines is taking time, and a lot more time than was originally assumed. It may take 7 to 10 years to bring a discovery right through to production. This means that decisions that are being made now that will affect supply 5 years out are based on developers that haven't even started construction yet. What this means for investors is that utilities may not appear to be panicking, but their runway is certainly shortening. Contracting urgency tends to occur after the inflection point, not before it. The third point we need to watch for in terms of contracting are these subtle but very important shifts we're seeing in the terms surrounding contracts. What we've been seeing more recently are floor and ceiling pricing that has been returning. We're seeing that contracts are increasingly indexed to inflation or to production costs. We're seeing that there's greater volume flexibility baked into these things to give the utilities the optionality they're looking for. We are not, however, at the point where we're seeing developers dictate terms. They're definitely beyond the point of being desperate to sign any agreement, but we are certainly expecting to see those terms tighten up and become more and more favorable for producers over the utilities. So what this means for investors is that before we really see fireworks in terms of volumes and prices, we're going to see the terms themselves become much more favorable for suppliers. Now, the fourth and final point, which is also one that's easier for us to watch, is the uncovered demand wall, which is getting closer and closer. Every year we see the World Nuclear Association put together its forecasts for the amount of uranium that is being covered by contracts or not. What we've been able to see from our most recent numbers is that at least 50% of the uranium required beyond 2027 has not yet been contracted. What we're also seeing is that between 2030 and 2035, most of that is still largely uncovered and uncontracted. And most importantly to all of these projections is that new mines have not been started up to fill those gaps, and they certainly won't be in time. All of this boils down to the fact that the term market is really where we're going to see the real supply gap emerge and become visible to us. What this means for investors is that if you're waiting for the spot price to spike, then you're definitely going to miss the move. The groundwork is being set right now, quietly, in the term market. What needs to be kept in mind is that we are not yet in a contracting frenzy, and that's why this moment matters. What we're seeing is that new material is slow to evolve. We're seeing that contract structures are evolving. We're seeing that volume momentum is building. This isn't the top of the cycle. This is the setup. And if you think this is important and you've enjoyed this video, I'd please ask you to look at a few more.